you've laid out your strategy. You call it responsible growth.
Yeah.
You've had increased revenue, reduced costs, increased earnings, which comes from those two factors. Made a lot of progress. I think everyone would agree with that, and your stock price reflects that. What comes next? How do you keep it going? Because, I mean, some of what you had to do was deal with some crises that you took care of, but now it's not so much crisis management as going forward.
Well, what we call responsible growth is more a set of principles. In our 8 lines of business, there are strategies. Responsible growth is a way to get people to think about it. And we want people to think about the transition where the world talked about us as being in crisis. Underneath it, we were making tremendous investments in the platform and the strategies we're developing. And we had to get people to switch. So the first thing, we have to grow, no excuses. We have to win in the marketplace. We have to be successful for our clients. The second part of responsible growth is we've got to do it on a customer-focused basis. It's illegal in the United States for us to make an acquisition. We have no desire to make acquisitions, so it's all organic, customer-driven. The third part's the risk, manage the risk well, and that's in good times you have to be more careful at managing risk as well as in bad times, because in bad times you know what the problems are. And so in the good times it's a question of what could the problem be, and that's where you have to manage it. And the fourth is we have to be sustainable. And we talk about being sustainable, having the best pace for people to work, our team, our communities, sharing success with communities, and then having operational excellence. And getting all that to work is what we're driving at. And so if you think about it, if you think about us going forward, what are we going to do? We have a consumer business, retail, which, core checking accounts, credit cards, mortgages, home equity loans, auto loans, and we're just driving that through. Providing better and better client service, more and more technology, more locations and places we weren't, and you keep investing in the business and materializing on the scale and capabilities, all the while the cost of operations is coming down. That's what operational excellence is all about. How do we continue to take out costs because of historical inefficiencies, customer change of behavior, automation, digitization, all that stuff, and just drive it through. And that's what we're going on. You get in the wealth management business, #1 in the business in the United States, and how profit and revenues and all the different ways you count it. Great brands, U.S. Trust and Merrill Lynch. But the question going forward is, how do we now deal with the revenue compression and the automation of the practice in the broadest context, which people use the word robo-advisor to describe it. And how do you make a financial advisor the ability to do more and offload more of the work for them so they can be more successful and spend more of the time working with the client as opposed to working in the back, trying to think of how to move the client's assets around, things like that. More planning, more needs-based and stuff. When you go to the corporate side, we have a tremendous commercial business, whether small, medium, and large-sized business all over the United States, globally on the high end. And the job there is, helping support these clients and helping them grow, but there's tremendous opportunity for us to do capital markets activities for our mid-sized clients that our market share is single digits, and it should be multiples that. And those teams are working on that, so how do you deploy there? And then you go in the corporate investment banking markets. Markets will be a business where we'll always invest in, we're one of the top players in it, but it will be constrained a bit by the amount of risk we're willing to take, and we want it to be more stable, and Tom Montag and team done a great job. I look back, and if you sort of project out this quarter's revenue in that business, it's basically gone between 12.9 and 13.6 billion for every year. And so it's not really moved up and down like people said. Now, you compare quarter to quarter, and so he's stabilized, and the team's done a great job. But really, it's all about driving, operational excellence to keep reducing the cost and automating that business. And so each of the business has those 4 tenets going through it.
So let's talk about trading for a second, because you brought us to that. FICC trading right now is sort of almost an existential question for the major banks. We hear it all the time. Every quarter we look at that carefully. Are you saying that basically we don't need to grow the top line in that, because doing that might incur more risk than we're comfortable with, but we can increase profitability through reduced risk? Is that the strategy?
Our risk from 2010 to now in fixed income, we're 10% of the risk level. And if you took today's portfolio and put that volatility from 2010, it'd still be 4 times less. And you're making as much revenue or more. And so it's the throughput of which we do. It's moving stuff through the system as opposed to having big balance sheets that you're storing assets. And that's by the way, it's same is true in equities. And so that's what we're driving at. We are a big fixed income player because we have the big issuing clients and we have the big investing clients, and we match them together and bring them together. And then, but you got to automate that business. So Jimmy DeMauro and Bernie Menza and the team that works on it, they are bringing to that the electronification, just like we did in the in the equities business across time, and so they have ability to trade whole loans by getting bids around the market. Think of the early NASDAQ market making days in equities. They're just doing that in whole loans through an automated bidding system that they've built, and so people can see. So it's not only the ones we have in our that we originate, but other people originate, so you can do it. So you get in these very important ways you improve the profitability of it without necessarily growing the top line beyond what the market's going to give you as it generally grows and as it generally ebbs and flows with volatility and what's going on. You know, people rushing to issue, not rushing to issue. And that's what you're trying to follow. You're trying to follow the market and the clients, not create independent risk that you're taking. That's the way we run that business, and they do a fabulous job of doing it.
Is there a similar approach with credit cards, a very different sort of product, credit cards? Because you have not grown your top line as fast as some other people have. There are a couple others that are ahead of you. Is it your goal to try to catch up with them? Because you have managed your risk. I mean, you really have lower credit costs than a lot of other people. How are you looking at that? How can you grow your credit card business?
So to think about that, you've got to go back and think about the whole consumer business. And so if you went back a generation ago, we were in the credit card business as a standalone business whose only job was to get another credit card. So they had thousands of Affinity partners. They had an independent origination platform, and we attached it to the front end of Bank of America, and that led to an interesting outcome, which is we charged off $60 billion of credit cards. So we had $150, $175 billion of pure cards. We had about another $50 billion around the unsecured business. We brought that all the way down to about 85 billion or so, and we built that back up, or in the mid-80s, and built it back up. So it's grown. It's grown a couple $1 billion. But the risk went way down. The cost of origination went way down. The net origination of new cards goes up every quarter as opposed to you're running to stay in place. And we still have great Affinity partnerships in that. But the Affinity that we're working on, aside from those few partners that drive it, is the Affinity of Bank of America. So our combined rewards program with our credit card in our bank account, in the combined way you qualify and get credit for it, is unique. And so we're completely relationship driven. So we want David Westin, we want his core account, which he transacts in his household, his checking account, that he sends his monthly bills out and his big paycheck comes into and all that good stuff. We want his credit card, we want his mortgage, we want his home equity loan, we want his auto loan, and we want that household, he want his significant other, we want his kids. You're driving, and you just keep driving at that. And you want the primary position. You want your card to be used first, so we put a lot of emphasis on how we get to use it. That's the combined rewards programs, travel rewards, cash rewards, the things that we've driven to use our card first. That's all about what we're doing. So when we brought it down, it was really to get the risk out, but it was really to get to a natural level that you could grow back out against our card business. Now the good news is, we're third or fourth largest credit card company in America. If you looked at standalone, we don't look at that at all. And it's as profitable as it's ever been. It just does it completely differently. And so if you look at the risk we have in the business through the stress test and other things, we charged off, I think, 12% in 1 year in that business. Now we charge off in 9 quarters on the stress test with 10% unemployment, like 11 or 12%. 2 years plus a quarter, 10% unemployment. The risk is so different, that creates a stability in the company. And that's what responsible growth means to us. But it comes from that drive and that penetration, driving that value proposition for that customer to use that product because they get more for it from Bank of America than they can anybody else.